to get as high as it did from trend in 2013, which would give us 1 million.
When it's all happening, if Bitcoin starts breaking out of these patterns that it's been forming,
potential returns each cycle go down as the market cap gets bigger and bigger.
Not because the world's collapsing, it's because there's going to be adoption by the real large pools of capital.
The next big thing after that is, I think 100,000 is going to be an issue.
The question I'm being asked most at the moment, Raoul, is, Pete, what do you think the top will be? And we are seeing a range of predictions. I've seen 288 from Plan B. I've seen 400. I've even seen a tweet storm from you where you talked about it even has the ability, I think, did you peak at 1.2 million?
Right, but it could actually hyperextend to get as high as it did from trend in 2013, which will give us 1 million. So I think we might see a longer correction. So I think the returns go down over time anyway. And I think we've seen that in the cycles. So, but what is the return from the next cycle peak to the next cycle peak? I don't know, call it 200 to 2 million, who knows? Another 10x. Not many things give you 10x. It's 1 million, but not for this cycle. But it's possible that it overshoots. So I've just used a regression line and used the trend of the log scale. And basically it says somewhere between Plan B and 400,000, 400,000 is right, but it could actually hyperextend to get as high as it did from trend in 2013, which would give us 1 million. So I think it's skewed slightly higher than people expect. I don't think it gets to 1 million, but we've got institutions coming in. Who knows how this dynamic changes? So I do think it's interesting. The other thing for people to bear in mind is there's a couple of price hurdles that are coming up that people haven't thought through. The first one is Coinbase's IPO. So if you are an institution who wants to buy Bitcoin and you've got to go through all this rigmarole to try and get it signed off, and Coinbase IPO comes out and it's a $60 billion company, and you can stick a few billion in, it's a good enough proxy for a while. So my guess is that's going to take out a lot of demand from institutions in the short term. It's not a long-term thing, but it will absorb quite a lot of the demand. The next big thing after that is, I think 100,000 is going to be an issue, because a lot of people got in around 10. A lot of people will have made 10 times their money, and 100,000 is a round number, and people think, let me take half my chips off the table. So I think we might see a longer correction. And my guess is, my framework I'm using, and I'm using some seasonal analysis, suggests that we go up to 50,000 into March. That works perfectly for the Coinbase IPO. Everything calms down because institutional buyers stop piling into Bitcoin futures. They buy a bit of Coinbase first because they can justify it easily because it's just an equity. And then the next run, I think, takes us to 100,000 into June, by which case there's going to be a lot of profit taking. The point you need to think about is what happens in that 4 years? How much cash do you need? You will take some money off the table and run the rest. I think most of us will do that. I don't think most people, because they now understand what this is. So I think people take some off the table at whatever high price you choose. People will scale out. Institutions will keep buying further up for the reasons we talked about before, market cap reasons, stuff like that. And then I think you're right. A lot of people will just hold a lot more than was held on the last cycle, and a lot more than was held on the cycle behind that. For those reasons. But the potential returns each cycle go down as the market cap gets bigger and bigger, because retail cannot drive. If I sell it to you and there's only one in existence, you can drive up the price. If there's two of you bidding for it, you can drive up the price. But a lot of retail investors are in, the institutions coming in, and then it becomes really hard to go from a $5 trillion asset to $10 trillion. To $20 trillion. So I think the returns go down over time anyway. And I think we've seen that in the cycles. So, but what is the return from the next cycle peak to the next cycle peak? I don't know, call it 200 to 2 million, who knows? Another 10x. Not many things give you 10x. And I can see the community starting to think it through. It started with stacking sats, but it feels a bit awkward and a bit of a forced narrative. We kind of have to explain to people that the price is not, that the headline price, you don't have to buy one of these. It's basically, we just have to explain that to the average person. But again, don't forget, retail is handing the baton on to institutions here. So retail investors will find it hard, and we all want retail participation, not because it drives up prices, because we truly believe it's the best thing for them to do, to have a chance for their futures to be able to pay off student loans or whatever it may be. So we all passionately believe it has a real place in people's personal portfolios, whoever they are and however little money they've got. But the institutions, will continue to drive that whole thing higher because they understand that price is just a number. It's just a number. We just have to get better as a community. As you know, the thing for me that I've been trying to drive is institutional adoption, speak the language. And I can tell from you who haven't come from finance, asking questions, I'm like, okay, fascinating, right? Because you're thinking as an individual investor. We have to now also talk the language of those individual investors and say, listen, just because it's $1 million doesn't mean you can't buy any. But Robinhood, good or bad, have also fractionalized shares. So people are starting to get it. It depends. If it just remains a reserve asset, and when it gets, full price discovery, it goes to this 5 volatility asset. It looks like kind of bonds or gold's a bit more volatile, but something of that sort. It will just be another line on the Bloomberg screen. And everybody analyzing what's going to drive the price. Do I need to increase my allocation? However, there's the other part of this whole equation that you and I really haven't talked about, is what technology gets built on it. So therefore,
true, yeah.
What could it be its future value? So maybe it always remains this weird hybrid of a call option on technology and a reserve asset at the same time. Maybe it does. I mean, Google's been that really. So, Google is a search engine that makes advertising revenue, but it has a lot of call options. Amazon's done the same. AWS was one of the best call options they ever had. It's probably different. It probably ends up looking more like an equity in terms of how it moves around and the kind of narratives that drive it than a bond that become just a macro variable.
Probably above 50% now. Really, I've reduced cash, put that into Bitcoin. My trading positions are relatively small because I don't think there's as much opportunity as there is in Bitcoin. So really, mainly a bit of cash, some gold and Bitcoin. And I'm even toying with the idea of selling my gold to buy Bitcoin. So even if they have negative 5% interest rates, I'm going to lose 5% in a year. It doesn't bother me in the kind of time horizon we're talking. If I'm talking about 10-year time horizon, of course I care. But over the next 6 months, even if there's negative interest rates, it's not the end of the world. Yes, and I am and remain so, and I don't dislike gold. But when you get to the macro opportunity, when it's all happening, if Bitcoin starts breaking out of these patterns that it's been forming, it is going to massively outperform gold. I'm 100% sure of that. So in which case, why would I have the gold allocation? I don't think the money leaves the bond market. I think like Japan, I think the bond market continues to attract pension assets and a whole bunch of others. So I'm not fearful of hyperinflation, default, or anything else. What I'm interested in is people adopting a different monetary unit for their savings and reserve assets. It started with retail. It's started to move into hedge funds. We're not there yet. You can't prime broke Bitcoin assets, but that's coming. We're starting to see family offices in the space. Next is the institutions, the endowments, the pension plans. And within that, you'll find some government, it'll be somebody like Nicaragua or somebody will suddenly say, we've allocated 5% to Bitcoin. Somebody who's always had problems with currency devaluation. That's going to come, and it's going to be another huge story, much like the Michael Saylor story, that will come out of nowhere and everyone's going to go, that's just changed the world again. So I'm not worried, because how I structure my portfolios is when I take a big bet like that, I know that I've got 50% downside or so, and that's okay for me because the upside's so much bigger. Right. And that, whether it's 5 years, 6 years, we're going to go through 2 of these halving cycles. And just from what I know from all of the institutions, all of the people I speak to, there is an enormous wall of money coming into this. It's an enormous wall of money. Just the pipes aren't there to allow people to do it yet. And that's coming, but it's on everybody's radar screen, and there's a lot of smart people working on it. So I think it's going to be not because the world's collapsing, it's because there's going to be adoption by the real large pools of capital, 5 and 6% year on year, which would make it the worst recession since the 1930s. Now, that's after the semi-recovery, and then parts of the stock market are at all-time highs. Things like banks and stuff, and oil companies and the old economy are all falling in price because they're covered in debts or the economic models change. Yeah, this is a truly extraordinary market. I mean, to sum it up, the spread between gold miners, which are kind of limited debts, cash flow businesses right now, and banks was 86% by about July this year. 86% difference in the favor of gold miners versus banks. I've never seen anything like that in a 6-7 month period.